warm welcome to Talking Stocks. I'm Gugulethu Cele. In studio with me is Peter Armitage and Sean Ashton, both from Anchor Capital. Today we're talking sugar producer that does other things on the side too, Tongaat Hulett. Good to have you both, as always, gentlemen. Sean, let's start with you. When I think Tongaat Hulett, I think we all think sugar, but it's not necessarily restricted to that.
I think the story's changed completely in the last few years, and the fact that sugar is shrinking at the rate that it is means that this business is more of a land bank with a little bit of sugar on the side. And I think the management team has probably felt compelled, given the pressure that the sugar market is under and the consequent poor results of the sugar division, to provide a lot more disclosure around what their land holdings actually are, what they're going to develop, and to help us find some guidance on the value of that stuff. And we think it's extremely valuable, and that actually they should split this business into two elements, really a land bank or a property development company with sugar on the side. Sugar is probably less than 10% of the value of the business today.
Less than 10%?
Yeah.
That's a bit of a surprise. I think a lot of investors might be shocked by that as well. But maybe if we zone into the sugar element just for a little bit further. Peter, clearly commodity prices, impacted by the weather as well here. It hasn't been a sweet time, if I can use that pie.
Yeah, so sugar is the sweetener as opposed to the core story, I guess. But so Sean says 10%. I don't think management would agree with that. That's our valuation, and that's what we think. But sugar's always been a bit confusing because you've got a lot of milling capacity, and they kept on telling us they're going to fill it up because obviously if you've got all this capacity and you can chuck more sugar through, it makes a lot of money. Big growth into Zimbabwe, but people are obviously concerned about Zimbabwe. Most other corporates or lots of people have had their assets basically taken away from them. And then they've had preferential access and pricing into the European Union from their sugar, and that's coming under question, and certain things are expiring. So it's quite difficult to get a proper handle on sugar. The one thing you know for sure is the sugar price has plummeted downwards. And sugar is very cyclical. It's very dependent on the rain patterns in places like South America. So sugar, you've kind of got to play the cycles. If you look at the pure sugar play, which is Illovo, they've come out with really terrible earnings and forecasts earning significantly worse. So sugar business by itself is a difficult place to be. And I don't have a huge amount of certainty in terms of our forecasts for the sugar business. But as we're pointing out, in terms of the value and why we investing in Tongaat, it's not that material to the investment case.
Sean, maybe if you can walk us through some of the metrics. We just saw the graphs on screen. Poor share price performance on the back of not only volume sales, but just on the bout of the performance of this particular equity stock. And I take it you're not optimistic on sugar performance
Certainly
in 2016.
Not. I think going into 2016, they've already the management team has guided that it's going to be under pressure. And I think a lot of it comes through from drought conditions in South Africa. So you've seen sugar volumes have actually grown in the other regions that they operate in, Mozambique, Zimbabwe, but South Africa has come under significant pressure. 15% volume erosion last year, which obviously drove the 10% profit decline that you saw in the division for 2015. We think it could be quite significantly worse coming into the coming year, because obviously you have an element of fixed costs, and as volumes erode even further, so you get to a point where your margins really start to take heat. And they're actually saying that the sugar production in South Africa will be down 22% for the coming year. That's their estimate of where volumes are going. So there's every possibility. When you look at the South African sugar business, profits came down substantially to about 240 million rand this last year. We think it could break even or even make a small loss this year, which would drive more or less a 40% reduction in overall profitability for that division. But just to put it into perspective, the reason I say it's not a huge part of the value is that if you take the view that sugar is going to be down of the order of 40 to 50%, which we think it could be, like Pete says, there's a huge amount of forecast uncertainty around that. So I wouldn't hang my hat on the exact number, but we think it's going to be a significant erosion. Placing a 10p on those earnings and taking out the minorities that they have in Zimbabwe, which they don't own, that would equate to 18 Rand a share of value. The share price is 130 odd rands a share. So we don't think that sugar is really the core part of this business anymore. But when you look at the land holdings for a long time, they've given us detail on the land. It's about 8,000 developable hectares that they have in the KZN area. And really what they've done in this last set of results is give us a whole lot more detail on the pace at which they expect to develop that land and the prices that they will achieve for that land, which is where we see quite substantial upside.
And I think that's an important point, Gugu, is Tongaat, if you look back 3-4 years ago, the way they explained their land was to show lovely pictures and draw red circles around that's our land. I think with sugar getting worse, and probably more importantly, their confidence level in the path and time at which they can realize the property values, they're now giving quite granular information. And it enables Excel nerds like us to go and kind of work it all out and come up with a fair value. And that value is looking dramatic.
I want us to take a look at that possible land
Sure.
valuation, as you obviously have a slide on that, and the sustainability of this, because surely land runs out at some point.
Absolutely. So, I mean, once you've sold the land, that's the value that you've realized, right?
But you got that in cash.
But I think, and you create that in cash, but I think the tail of the extent of the land that they have is very long. They're not going to sell it for many, many years. And just to paint a picture, so they've got 8,000 developable hectares that they expect, or that they have right now. They've said to us the portion of that land over which they will develop and make sales over the next 5 years, in other words, within 0 to 5 years, will be about 3,800 hectares. That includes a 42-hectare parcel, which we think will be imminently sold in the Umhlanga Ridgeside development, which is it's a prime coastal property in Umhlanga.
Prime where all the new buildings are going up. They own the land right in the middle.
And that will sell for probably 30 million rand a hectare. So they could make well north of R1 billion worth of profits just in that 42-hectare parcel. It was a big number that we thought would come into 2015's earnings. It didn't. It'll probably come in next year. And just to contextualize it, if they sold that, that's R7.50 a share worth of profits just from that one parcel of land. And naturally, you put a 1p on that. But even beyond that, what they've said to us is out of that 3,800 hectares over the next 5 years from which sales will take place, they've given ranges. So they've said that at the low end, they expect to develop and sell off 635 hectares, and at the high end, just shy of 2,000 hectares. And from a weighted average profit per hectare point of view, they're saying, well, we work it out. They give a lot of detail for each of the land parcels, but we work it out to be a low end of 6 million rand a hectare and a high end of 8 million rand a hectare. So that means that over the next 5 years, there's only 1,800 or 2,000 hectares of the 3,800, which they're likely to sell, which will result in cumulative profits of anything between 3.8 billion and 15 billion rand. It's a very wide range, but we've taken a midpoint of that range, and we expect that will result in sustainable profits flowing through of about 2 billion rands a year from land.
Over the next 5 years?
On average, over the next 5 years.
And Gugu, the market cap is 12 billion.
The market cap, I think it's about 15 or thereabouts billion. Yeah.
So, you're talking about 2 billion rand a year in the context of a market cap that's moving between 12, 13, it's been as high as probably 20 over the course of the last year. But you can see why the value comes through. And that value, what's quite right, when you look at it, you go, well, it's land and then it's gone. But ultimately, if you realize cash for it, you've got to compare the cash that will draw in the business, which is close to the market cap over 5 or 6 years. And that equates to the total value of the business. And then they've still got, 3/4 of their land left, and they've still got their sugar business and still got their starch business. And something we haven't talked about is we're in fact valuing their starch business at more than their sugar business at the moment, which I don't think over time is the case. I mean, intrinsically in a reasonable market, the sugar business would be worth 4 times the starch business, in good conditions at good margins. But if it's kind of a point in time type valuation.
So what does this mean for the overall group valuation of this particular stock, which has seen better days?
So I think what we're saying is that if you look at the midpoint of land and the likely scenarios that they've presented, we're saying R12.50 a share of earnings over the next 5 years from land, plus you're still left with a tail of more than 50% of the acreages that they haven't yet sold.
Yeah.
So we're saying land could be worth something of the order of 230 rand a share. Sugar is very small, it's probably less than 20 rand a share, but we're also being punitive by saying let's put a 10p on next year's depressed earnings. It could come back. We've got no conviction around timing, but it could well come back. And then starch is the remainder. Plus, they've also got some debt. So, I mean, if you look at it holistically, you're probably saying 250 rands a share of intrinsic value, of which the vast majority is the land bank, as I call it. That's why they need to really split these things into two. Importantly, we're not saying that the share price should necessarily race up to 250. But because the market at the end of the day is going to say, well, there's intrinsic value of land, And then there's also the earnings that are coming out of that land, and the two might not match because you're not going to be developing all of your land all at once. But I think the point to make here is that there's a very long, deep tail of value that's locked up in this business that should be realized over an extended time period.
The all-important question, if we're not buying it for the sugar business, but more land and potentially starch, buy, hold or sell, Peter?
So this has got to be a buy. We sit here week after week trying to justify high share prices on our market. This is probably the first time in the last year we've come and said the intrinsic value of a share is close to double the share price. So it's exciting. I don't know when you'll get your value out of it, but if you're willing to take a view over a few years, you're going to make a lot of money out of this.
And I take it it's affordable, Peter, because it's Sean, excuse me, because the PE sits at 16 about.
Sure, I think that's the trailing PE, which has got quite a low profit base from a land point of view and sugar. Trying to assess it on PE multiples is actually almost impossible right now, because I think the earnings stream naturally is going to be very lumpy associated with land, because you don't know exactly when they're going to transact. So PE multiples is probably not the right way to look at this business. But if you were to look at it that way, I'd say, well, they could even earn close to 20 Rand a share next year. I don't know. It depends on whether they transact on a
Mhlanga. Then give it a 6 PE.
Then it's a 6 PE. Yeah, but R7.50 a share of those earnings are Mhlanga Ridge side, which is a 1 PE transaction. They've still obviously got a lot more to come, but we don't know exactly if you can average it out over, take the 5-year average and say, well, it'll be 1/5 every year. We don't know that. But so I think that the uncertainty around earnings is high, forecast risk is high. So P multiple could be very low. It's likely to be a lot lower than it was last year. But ultimately, I think if we don't look at it on P's. We like to say what is the value of the assets that they own, and the value of the assets that they own, irrespective of the timing at which they will realize that, is significantly higher than the share price today. So it's a buy for me too.
Clear consensus then, buy for Tongaat Hulett. Well, that's where we have to leave it for this week's edition of Talking Stocks. Do join us again next time.